So Microchip Technology just delivered an absolute clean beat across the board for their Q1 fiscal 2027 earnings.
Yeah, revenue came in at $1.485 billion, and that is a 38% jump year over year.
Massive.
Right. Plus a 13.2% sequential increase. I mean, they easily cleared that $1.46 billion Wall Street consensus.
And the bottom line followed suit with, honestly, serious aggression. Non-GAAP EPS hit 76 cents.
Which is up 181.5% year over year.
Exactly, comfortably beating the $0.70 street estimate.
Yeah.
And just for context on the accounting, GAAP EPS came in at $0.37.
Mm.
But if you're watching the stock today, the historical numbers aren't what caused the massive volatility.
Oh, not at all.
The real shockwave was the forward guidance.
Management's Q2 fiscal 2027 projections completely reset the baseline. They guided revenue to a range between $1.589 billion and $1.618 billion.
So at the midpoint, you were looking at a 7 to 9% sequential bump, right?
Yeah, and roughly 40.6% year-over-year growth. But even more telling, they guided Q2 non-GAAP EPS to a range of 91 to 95 cents. I mean, that doesn't just beat the $1.76 consensus, it absolutely obliterates it.
Which perfectly explains the absolute whiplash we saw in the market.
Oh, for sure.
Because during the regular trading session, before the numbers actually dropped, the stock dipped 4.4% to close around $74.36.
Right. People were nervous.
But the second that earnings release hit the wire, and the algorithm scraped that Q2 guidance, it triggered a massive, violent reversal. Shares surged 8.6% in after hours, trading to $80.77.
And then they just rode that momentum the following day to trade up nearly 13%, crossing north of $81.
It was crazy to watch.
You are looking at a textbook example of a market that had fundamentally mispriced the velocity of a recovery. I mean, institutions had to scramble to update their discounted cash flow models overnight.
Yeah, they were caught completely off guard.
Definitely. And to understand the mechanics of why the stock reacted that aggressively, you have to look past just the top-line revenue beat. The hidden engine driving that valuation spike is massive operational leverage,
combined with a brutal, highly effective inventory cleanup. Let's break down the mechanics of that operational leverage, because the margin expansion here is just staggering. Non-GAAP gross margin expanded 222 basis points sequentially,
hitting 63.8%.
Right. And it gets even more dramatic further down the income statement. Non-GAAP operating margin surged 452 basis points sequentially, landing at 35.1%.
And look, when you see a company expanding its operating margin twice as fast as its gross margin, you are witnessing pure operational leverage in action.
Right, because the fixed costs are capped.
Exactly. It means they're keeping a massive lid on their fixed operating expenses, things like SG&A and overhead, while the actual revenue scales up. So every incremental dollar of sales is falling almost directly to the bottom line.
And a massive piece of that margin expansion is tied directly to the inventory pipeline finally clearing out, right? We saw internal inventory days drop from 185 at the end of March down to 175 by the end of June.
10 days.
Yeah, they basically just flushed 10 days worth of global backlog out of their warehouses in a single quarter.
But, the internal numbers only tell half the story here. The real indicator of future demand is the channel inventory.
The stock's sitting with third-party distributors.
Right. Right now, distributor inventories are sitting at near historic lows of roughly 26 to 27 days.
Think about what that actually means in the real world for a second. A distributor holding 26 days of inventory is essentially staring at bare shelves.
Yep. It's a panic scenario for them.
Because if you are a manufacturer and your lead time to get a new batch of chips fabricated, tested, and shipped is, say, 90 days, but your distributor only has 26 days of product left to sell.
Math doesn't work.
Right. Panic sets in. The distributors are selling parts to end customers faster than they are bringing them in from Microchip.
And that dynamic is exactly why bookings just hit their highest level in nearly 4 years. Microchip posted a book-to-bill ratio well above 1.
Meaning?
For every single dollar of product they shipped out the door and billed for, they received more than $1 in new firm orders. So the pipeline isn't just full, it is actively expanding.
Okay, I hear you on the pipeline, but I have to challenge the sustainability of these margins for a second.
Fair enough.
Because management was very transparent on the call. They noted that Q1 benefited from lower underutilization charges, but they also explicitly warned that they saw one-time benefits from licensing and distribution price change reserves.
Right, the non-repeating stuff.
Exactly, things that will not repeat. So if you strip away those one-off accounting benefits, is this 63.8% gross margin a permanent structural shift? Or is it just a temporary sugar high that fades the second those reserves dry up?
It is the exact right question to ask when you see one-off items padding a balance sheet. But the mirage argument kind of falls apart when you look at the Q2 guidance.
Because they guided higher.
Exactly. Management guided Q2 gross margins even higher to a range of 66.0% to 67.0%. They are forecasting margin expansion even with those one-time benefits completely removed.
So what fills the gap then? If the accounting benefits vanish, what is physically driving the margin up to 67%?
Factory utilization. To understand semiconductor margins, you have to understand fabrication plant economics.
The massive fixed costs.
Right. These are multi-billion-dollar facilities with massive, inflexible fixed costs. The depreciation on the machines, the electricity, the specialized labor, you pay for all of that, whether the factory is running at 100% capacity or 30% capacity.
And when demand slows down, like we saw over the last year, and you idle those production lines, you get hit with those underutilization charges.
Yes, those charges actively destroy your gross margin because you are basically absorbing the cost of an empty factory.
But now the distributors are staring at bare shelves and placing massive reorders.
Those factories have to spin back up to maximum capacity. The volume returns to the factory floor. The machines run 204/7.
Right.
And you spread those massive fixed costs over millions of newly minted chips, and the underutilization charges just melt away.
So this isn't a temporary spike. It is the natural structural profitability of Microchip's business model reasserting itself as the heavy machinery gets put back to work. Which pushes us to the most critical variable in this entire earnings report, I think. Because if bookings are hitting 4-year highs and the fabs are running hot again, where's this immense wave of demand actually originating?
That's the billion-dollar question.
Because if you look at the broader macroeconomic picture, consumers aren't exactly buying cars, washing machines, and industrial equipment at record-breaking rates right now.
They definitely aren't. So the demand is not a broad, uniform macroeconomic recovery. It is highly concentrated. And that takes us directly into Microchip's absolute standout segment.
Data center and AI infrastructure.
Yes.
The internal projections here are just staggering. Microchip is projecting their data center-related revenue to surge 69%, targeting approximately $1 billion in calendar 2026.
Which is wild.
For context, they're estimating that segment at just $591 million for 2025. You do not see 69% segment growth in legacy compute.
Because it has nothing to do with legacy compute. This growth is entirely fueled by the physical realities of building out AI infrastructure. We are talking about highly specialized connectivity components.
Like the PCIe Gen 6 switches.
Right, the Gen 6 switches, retimers, advanced power management systems, and memory products like CXL controllers.
Let's explain why these specific components are suddenly in such high demand. Because everyone focuses on the engines of the AI revolution, right? The massive GPU clusters from NVIDIA or AMD.
The shiny stuff.
Exactly. But if you pack thousands of cutting-edge GPUs into a data center to train a large language model, the raw computing power isn't actually your biggest problem.
No, your biggest problem is the data traffic jam.
Right.
Think of a standard AI server rack, like a hyper-advanced city. The GPUs are the skyscrapers processing data at unbelievable speeds. But if the roads connecting those skyscrapers are dirt paths, the entire city gridlocks.
It just stops working.
Exactly.
Right.
So Microchip's PCIe Gen 6 switches are essentially massive multi-lane digital superhighways with highly intelligent traffic cops. They ensure that data flows between the GPUs, the CPUs, and the memory at 64 gigatransfers per second without colliding or bottlenecking.
Okay, so Microchip isn't just selling the standard picks and shovels for the AI gold rush. They are selling the specialized reinforcement beams for the mine shafts.
I love that analogy, yes.
Because these massive GPU clusters absolutely require them to communicate. And what about the retimers?
Retimers solve a literal physical physics problem. When you push electrical signals at those extreme Gen 6 speeds across a physical motherboard, the signal degrades rapidly over distance. It gets noisy and weak.
So it needs a boost.
Exactly. Retimers act as ultra-fast signal boosters. They catch the degrading signal, clean it up, amplify it, and shoot it down the line so the data arrives perfectly intact.
Because without PCIe switches and retimers, a billion-dollar GPU cluster essentially just stalls out.
It becomes a very expensive space heater.
Right. And we know hyperscalers are desperately locking down this technology because the leading indicators are flashing bright green here. Microchip reported that their PCIe Gen 6 connectivity design wins literally doubled sequentially.
Huge metric.
They went from 6 active programs at the end of the March quarter to 12 programs exiting June.
And we really have to emphasize how sticky a design win actually is in this industry. A design win doesn't just mean a customer bought a batch of chips.
Right, it's way deeper than that.
It means a major cloud provider or server manufacturer has physically engineered Microchip's specific component into the underlying architecture of their next-generation hardware.
So they are locked in.
Exactly. Once you are designed in, the engineering costs and the validation time required to swap you out for a competitor is astronomically high. When design wins double in 3 months, it locks in highly predictable recurring revenue for years to come.
It's the unglamorous, highly lucrative plumbing of the AI build-out.
Very lucrative.
And they aren't just defending the centralized data center, they're actively acquiring to expand their footprint because they recently made a strategic tuck-in acquisition of a company called Halo.
Right. Halo specializes in AI at the edge. So while Microchip's PCIe switches handle the massive data loads inside centralized cloud facilities, Halo gives them a foothold for decentralized AI.
For things like industrial machines and sensors.
Yeah, exactly. For when AI inference moves out of the cloud and into automotive sensors and smart cameras that need to process data locally without any latency.
But if you are looking at this stock, you have to realize you're essentially looking at two completely different business models operating under one ticker right now.
Yeah, that's a really important point.
Because as explosive as this data center growth is, it is still a minority slice of the overall revenue pie. Microchip's overall mix remains heavily anchored by their traditional legacy businesses.
Right. Mixed signal microcontrollers still make up 49.8% of their sales.
And analog products make up another 27.7%.
Which is exactly why this quarter is so compelling from an investment thesis standpoint. What you are witnessing is a massive secular structural transition superimposing itself over a standard cyclical turnaround.
Explain the physics of that overlap. How does that actually play out?
Okay, so the base business, the microcontrollers and analog chips going into everyday consumer and industrial products, that is recovering purely cyclically. Like we discussed earlier, the excess channel inventory has burned off, the rubber band snapped back, and distributors are reordering.
So that is your baseline cyclical floor.
Yes. But on top of that floor, you have this relentless secular wave of AI data center spending that operates completely independent of macro consumer spending.
It's just a totally different driver.
Exactly. When you overlay a structural AI rocket ship onto a foundational cyclical recovery, you get a uniquely powerful cash flow catalyst for Microchip's specific product mix.
And that surging cash flow fundamentally shifts our discussion to capital allocation. Because usually when a semiconductor company sees bookings hit a 4-year high, the first thing management does is announce a massive new multi-billion-dollar fabrication plant.
Right, they pour concrete.
But Microchip is doing the exact opposite here.
They are executing a remarkably capital-light strategy right now. Management has paused almost all major factory expansion. They guided their capital expenditures, or CapEx, to a very light $20 million to $25 million for Q2.
Wow.
And they are modeling just $100 million in CapEx for the entire fiscal year.
Which tells you that their existing physical footprint is perfectly adequate to handle the cyclical recovery of their base business.
Yeah.
They don't need to build new lines to stamp out more analog microcontrollers.
They have the capacity.
Right. So if the cash isn't going into concrete and steel, where is it being diverted?
It is being funneled aggressively into balance sheet deleveraging and shareholder returns. In Q1, they reduced their net debt by approximately $170 million.
And looking at their balance sheet, they entered the quarter carrying over $5.3 billion in long-term debt.
Which is a lot.
It is. And when you are operating in a macroeconomic environment with interest rates, this elevated, aggressively paying down principal is just critical financial hygiene.
Oh, totally. Because it immediately reduces interest expense, which flows directly to EPS. And concurrently, they are returning capital to investors. They paid out $246.9 million in dividends to common stockholders during the June quarter.
And they declared a 0.455 quarterly dividend for the upcoming September quarter. So they are simultaneously de-risking the enterprise while paying you to hold the equity.
It sounds incredibly bullish when you lay it all out like that.
It does. But as analysts, our job is to find the structural cracks in the narrative.
Always.
And CEO Steve Sanghi didn't hide the ball during the call. He specifically warned about intense supply chain constraints. But crucially, the bottlenecks he highlighted aren't internal.
No, they are external.
Right. He pointed directly to third-party foundries, substrate suppliers, and OSATs, which stands for Outsourced Semiconductor Assembly and Test Facilities.
And this is the critical vulnerability in the entire AI growth thesis, because Microchip is an IDM, an integrated device manufacturer.
Meaning they own their own fabs.
Yes, they own their own fabs and manufacture most of their own legacy microcontrollers and analog chips internally, but they do not have the internal capability to manufacture the highly advanced cutting-edge chips required for AI data centers.
So for the crown jewels, the PCIe Gen 6 switches and the high-speed retimers, they are entirely reliant on external partners.
Yes. They have to outsource the fabrication to advanced foundries like TSMC, and they have to outsource the packaging to OSATs in Asia who specialize in highly complex substrate integration.
And Microchip is competing for limited advanced node capacity against literally every other tech giant on the planet.
Exactly. They are in line with everyone else.
And if those third-party supply chains bottleneck, if there is a shortage of advanced packaging substrates, which honestly we have seen repeatedly over the last 2 years,
then Microchip's ability to actually realize that $1 billion data center target gets physically constrained.
because it doesn't matter if hyperscalers are begging for the chips. If the OSATs can't package them, Microchip can't ship them.
Which brings the entire valuation debate into sharp focus right now. Following this earnings print, Truist downgraded their price target on Microchip from $105 down to $90.
And kept it a hold rating, right?
Yep. Maintaining a hold rating specifically due to valuation concerns. Because if you look at the multiples, MCHP is currently trading at a forward PE of 21.8 times earnings.
And that multiple sits at a premium compared to the broader semiconductor sector average, which is hovering around 20.7 times. It's also a premium to direct analog peers like on Semi, which trades at roughly 21.1 times forward earnings.
Now, you can argue they trade at a discount compared to players like Texas Instruments at 29 times or Analog Devices at 25 times. But Truist's core argument is that the market has already priced in the cyclical recovery.
Right, the easy money from simply recognizing that the inventory glut has cleared out is already in the rearview mirror. That 13% post-earnings pop basically priced that in.
Yeah.
So the question is, are we entering priced for perfection territory? Because to justify further multiple expansion above 21.8 times, Microchip can't just rely on the baseline cyclical turnaround anymore.
No, they have to execute flawlessly on the secular AI transition, and they have to do it against fierce competition. I mean, Broadcom, Astera Labs, and Marvell are all aggressively targeting that exact same high-speed connectivity real estate inside the server rack.
And in the AI infrastructure space, product cycles move brutally fast.
So fast. The premium valuation means investors aren't just paying for today's stabilized margins, they're demanding flawless supply chain execution tomorrow.
And if they stumble on securing that third-party manufacturing capacity, or if competitors start eating into those PCIe design wins, that premium multiple could compress rapidly.
Even if their internal legacy factories are running perfectly.
Which leaves you with a fascinating strategic paradox to mull over as you track this company.
Yeah, it's a real duality because Microchip has brilliant operational leverage over its internal manufacturing. But for its most advanced, highest growth AI products, it is increasingly reliant on third-party foundries and OSATs. So if global semiconductor supply chains tighten up again, you have to ask yourself, could Microchip's absolute biggest catalyst for growth simultaneously become its greatest point of vulnerability?
That is the ultimate question heading into Q2. If you are actively trading this sector or just trying to understand the actual mechanics behind these massive market moves, make sure to follow the show for daily earnings coverage and actionable market recaps. We will be right here to tear the numbers down.